Most people don't think much about how banks are regulated, but the decisions being made in Washington right now could directly impact your money. President Trump has just appointed Michelle Bowman as the new head of bank supervision at the Federal Reserve, and this could bring a major shift in how banks handle risk and how much cash they're required to hold. The goal is to loosen regulations, giving banks more flexibility, but there's also concern that it could lead to increased instability. If the rules around banking change, does that put your money at risk? And what can you do to make sure your savings are protected? Let's take a closer look at what's happening. Bowman has been on the Federal Reserve's board since 2018 and has built a reputation for opposing stricter banking regulations. Now, she's in charge of overseeing the country's largest banks, setting policies that determine how much risk they can take on and how much cash they need to keep in reserve. Her appointment signals a shift toward easing restrictions that were put in place after the 2008 financial crisis, regulations designed to prevent reckless banking behavior. The argument in favor of loosening regulations is that it gives banks more freedom to lend, which can fuel economic growth. When banks aren't required to hold as much cash in reserve, they can approve more mortgages, business loans, and credit lines, making borrowing easier. Supporters believe this will boost the economy and create more opportunities for businesses and consumers. But there's also a downside. Regulations exist to ensure banks don't take on too much risk. Weakening these rules increases the chances of instability. We saw what happened in 2023 with Silicon Valley Bank and other regional banks. They grew rapidly, but when market conditions shifted, they collapsed because they didn't have enough cash on hand to cover their losses. If banks are allowed to operate with even fewer restrictions, it raises the question, could we see more failures in the future? One of the biggest concerns is whether these changes could make another financial crisis more likely. The 2008 collapse happened because banks took excessive risks without enough oversight. After that, regulations were put in place to prevent it from happening again. If those safeguards are rolled back, banks could prioritize short-term profits over long-term stability, leading to riskier lending, weaker financial protections, and a more fragile system. So what does this mean for your money? FDIC insurance still protects bank deposits up to $250,000 per account, but if banks start taking more risks, that system could be tested. It's a good idea to check if your deposits are within the insured limit and, if necessary, spread your money across multiple banks to ensure full coverage. Looser regulations might also mean easier access to credit, but that comes with its own risks. If banks start lending more aggressively, it could lead to an increase in risky loans. If the economy slows down, some of those loans may default, leading to potential bank losses. If you're planning to borrow money, pay close attention to interest rates and loan terms. Just because credit is easier to get doesn't mean it's always a good idea. Another thing to watch is how banks respond to these changes. If financial institutions face increased risk, they may pass costs on to consumers by raising fees, lowering savings interest rates, or making it more expensive to access credit. Keeping an eye on your bank's policies and comparing options can help you avoid unnecessary costs. Economic conditions could also shift depending on how these new policies play out. If banks take on too much risk and financial institutions become less stable, it could lead to market uncertainty, affecting everything from stock prices to job growth. These effects don't happen overnight, but they can build up over time, so it's worth staying informed about how these changes are unfolding. Banking regulations might not seem like something that impacts your daily life, but they play a major role in the security of your savings, the availability of loans, and the overall stability of the financial system. Whether these changes lead to economic growth or new financial risks is something we'll see in time, but being aware of these shifts helps you make better financial decisions.